Our next speaker is CA Vijaya Mohan, Managing Partner, EVAS International.
Hi, good afternoon. We had a long sessions going on very technical subjects like transfer pricing, arm's length pricing, international taxation and all. So now the next session is not that technical, but it is most relevant. I would say that how do the groups are being created, the groups structures in UAE, and how the corporate tax is taken care of with respect to the different group provisionings. So there are multiple questions people used to ask whenever we discuss about corporate tax. One is that with respect to the qualifying income, that will be the main question which people will be asking. The second thing is that, okay, my director is taking 100,000 dirham salary, whether that salary is being deductible expenses or not. The third thing is, one of the other thing is that I have 10 companies in UAE wherein we are having common shareholders. Some companies is having different kind of shareholding structures. What are all the group provisions which is available? Whether that group can continue to be a group for corporate taxes. So on, all these kind of questions used to come in. So that's the reason of taking group structuring as one of the discussion topic for today's discussion. So we will be discussing what are all the provisions which is relating to the tax groups. And also there are corporate tax provides some other group provisions. In certain scenarios, tax group may not be possible to be created, because tax group, there are certain specific requirements of a holding subsidiary company relationship is exist. In most of the group structures in UAE, that holding subsidiary company relationship may not be existing. So those companies, what are all the provisions available? Whether the transfer of assets and liabilities from one related party to the other related party, what will be the impact of taxes on corporate taxes on that? And also, what is the provisions available for transfer of tax losses from one company to the other company? So these are all practical scenarios, not technical, but it's a procedural aspect. It is better to understand these provisions with respect to the corporate tax law, so that it will help you in planning your the future implementation process. Also to help you to structure your transaction, structure your groups in a better way, and manage your corporate tax also in a better way. So we will first take it into the tax group provisions. So these are all the contents which we will be discussing. One is the tax group as per Article 40. Then there are two more group provisions are available. One group provision is with respect to relief. So when you are transferring, when two qualifying entities are transferring assets and liabilities between them, there is a relief. If they are part of a qualifying group, then the corporate tax impact on that gain or losses arising on that transfer is not included in the calculation of corporate tax. Also, there is another provision which is available is as per Article 38, that says about the transfer of losses from one company to the other company, which is also considered to be a group. So now, with relating to that transfer of losses, we will just touch upon the carry forward of losses. And also what business should do with respect to the group structuring, and how to take the corporate tax forward. So we will quickly see that what is a tax group. Tax group, when a tax group is formed, the entities which is part of tax group is considered as a single taxable person. That's a main point. So if you have 10 entities in a tax group, but only one entity will be filing the return, the parent entity will be representing the tax group. So now the second thing what will be coming into our mind on what are all these conditions which is required to be fulfilled in order to become a tax group. So the first two conditions are the most important thing. That means there should be a resident and juridical persons. So only the resident person can form a tax group, and there should be juridical person also. So the natural persons cannot be a part of a tax group, and also a non-resident person's PE in UAE cannot be formed part of a tax group. And the second is the most important condition, that the parent company should have at least 95% shareholding in the other subsidiary company in order to form a tax group, either directly or through other subsidiaries. So there should be a holding subsidiary relationship exist. Then only the tax group provision will be applicable. And the other conditions are that they should have the same accounting year, they should maintain they should be maintained the accounting using the accounting standards. Similar accounting standards should be used by both the parent company and the subsidiary companies, and none of these companies should be a qualifying free zone persons and exempt person. So these are all the conditions of becoming a tax group. So you understand that if you wanted to be a part of a tax group, The most important thing is that they should be a resident and juridical person, and also they should have a holding company subsidiary relationship, and at least 95% of the shareholding should be held by the parent company. Then only you can form a tax group. So here it is an example. Holding company A Limited is having a subsidiary company B FZD. B FZD is a qualifying free zone person holding, there is a 100% shareholding. And also, holding company A Limited is having another subsidiary company 100%, and subsidiary D LLC is having 80% shareholding, and there is another subsidiary E FZD, which is a non-qualifying person we hire, in which they have 100% shareholding. Which are all the companies can form a tax group? Subsidiary B FZD cannot be a part of a tax group because it's a qualifying free zone person. But subsidiary C LLC and subsidiary E FZD being a non-qualifying entity, non-qualifying free zone, it can form part of a tax group. So the financial statements of A Limited and subsidiary C LLC and E FZD should be made, and after eliminating all the intercompany transactions in order to find out the taxable income of the tax group. So the audited financial statements requirement will be coming if the taxable persons, that means the A Limited, C Limited and E Limited together, if it exceeds 50 million, then the audited financial statements requirement will also be coming in. So what are all the pros and cons of, or the benefits of having a tax group registration or having an individual registration? If you are forming a tax group, current year losses itself, if you are having a tax group, one company is having a tax loss and another company is having a taxable income, then that tax loss can be offsetted against the taxable income of the in there itself. But if that tax group is not formed, either the subsidiary company or the parent company who incurs a tax loss can carry forward, or it can transfer the tax loss to the other company if they meet the other conditions as specified in Article 38. The basic exemption limit, if you are having a taxable income as a tax group, then only one basic exemption limit will be available. But if you are having 10 separate registration, 10 separate companies will have a basic exemption limit of 375,000. And with regard to the administrative things, only one tax return to be filed if you are forming a tax group. But if you are having separate registration, you will have to have the multiple, as many companies, you will have to have the tax return filing and all the procedures to be followed. Now, with respect to tax group, even though you have been created a tax group, there are certain responsibilities which will not be lying on the parent company alone, like withholding tax treatment. Withholding tax treatment, that means nowadays, as per the provisions of the law, at present it is 0% tax rate. But that withholding tax can be increased at any time. When the withholding tax provisions has been implemented and the tax rate has been increased from 0%, the liability to file the withholding tax, collect the withholding tax is not lying on the parent company, it lies on the individual subsidiaries as well as the parent company. Whoever is expenses is booked, that they have to claim the, in order to claim the expenses, they have to withhold the tax and pay to the government in the respective capacity, not on the group level. Now, with respect to tax payment, who is responsible for tax payment? Tax payment, the responsibility lies on, it is a joint and several liability, or an application can be made by the taxable person. That means, okay, they have to restrict the liability to certain people. So the tax payment will become the responsibility, joint and several responsibility of the participants of the tax group. Now, on what are all the scenarios in which a tax group can be aligned? A subsidiary company shall leave the tax group. When the subsidiary company can leave the tax group, they can file an application to the authority and they can leave the tax group. Or if their shareholding structures has been changed, then also they can leave that group. Actually, the group shall ceases to exist. When the group conditions are not met, actually then that group will continue. The group will cease to exist, and then the tax group will be separated. And the parent company shareholding structure has been changed. When the parent company shareholding structure is also changed, that a new parent company can become the parent company, and the former parent company can leave the tax group. So whenever there is a realignment, the tax group structure will also get realigned to the new shareholding structures and new pattern. So how do you calculate the taxable income of the tax group? The taxable income of the tax group needs to be calculated based on the consolidated financial statements of the company. So after eliminating all the intercompany transactions, intercompany balances, a consolidated financial statements of the group is to be prepared, whoever being a part of the tax group, and based on that consolidated financial statements, the tax group taxable income will be calculated. And there are some tax laws adjustments. In the initial discussion, the panel discussion also, Anurag was discussing about the pre-grouping tax laws of the subsidiary company, or when the a new subsidiary company is joining to a tax group, what will be the existing tax laws, whether this can be offsetted against the profit of the subsidiary company when it is been newly joining, or when the group ceases to exist, what will happen to the unabsorbed tax losses? If there is a new subsidiary joining, if that subsidiary is having an existing loss, carry forward losses, that carry forward losses can only be offsetted against the future income of that particular subsidiary. It cannot be offsetted against the future income of the other parties of the tax group. Similarly, when a new subsidiary is joining, the existing carry forward losses of the group cannot be offsetted against the profit of the new subsidiary. Also, when the tax group provisions on cessation of the tax group, the parent company, if the parent company continues to be a taxable person, then the unabsorbed carry forward losses will remain with the parent company. Other parties will not be getting the benefit of it, other than the pre-grouping tax losses. So if the parent company is liquidated, ceases to be in existence, the unabsorbed tax losses, actually all the entities in the tax group will lose to get it. So that is also an important provision with respect to the tax group. So you have to plan the structures in such a way that the tax, how the tax loss provision will be applicable, how the losses can be offsetted, all these things to be taken into consideration while forming the tax group. So now that is with respect to the tax group. So what are all the other groups available in the corporate tax law wherein a tax group cannot be formed? That means there is no 95% cross-holding between the holding company and subsidiary companies are not available. So what are all the other provisions which is available in the corporate tax with respect to groups, with respect to the related parties? There are two articles which is refers to that. One is Article 26. Article 26 refers to that if you are a part of a qualifying group. In Article 26 is defining the qualifying group. Article 38 is not referring back to the qualifying group. It is a separate section itself. So as per Article 26, if you are a part of a qualifying group, the transfer of assets and liabilities between these two related parties or group companies will not be subject to corporate tax. If you are having any gains or losses arising on transfer of certain assets or liabilities, that gain will not be subject to corporate tax if you are a part of a qualifying group. Article 38 says that if you are a part of a group, then one company can transfer their losses to the other company and offset against the profit of the other company. So if you are part of a group and that A company is incurred a loss and B company is having a profit, A company's loss can be transferred to B company and B company's tax payable will be reduced by the amount of taxable income will be reduced by the amount of tax loss transferred from A company to B company. So what is the differences between these two groups actually? One is a qualifying group as per Article 26 and another one is a group as per the Article 38. Other than the applicability, it is actually the qualifying group as per the Article 26 with respect to relief is also applicable to a non-resident person having a PE in UAE. So other than that, these two provisions are completely same. So the applicability is for the tax relief purposes, it should be a juridical and resident persons, and it also includes non-resident persons having a PE in UAE. But for the group, for the purpose of transfer of tax losses, it is applicable only to juridical resident person. So what is the other main condition? How you become a qualifying group with respect to shareholding? Each company, either one company should have a shareholding of at least 75% on the other company, or another third party, a common third person having shareholding interest of at least 75% in both the companies. So A company and B company are there. Whether either A or B holds at least 75% in one another, then they will become a part of a group. Otherwise, another person C is having 75% shareholding in both A and B, then they will become a part of part of a qualifying group, or it will become a part of a group for the purpose of transfer of tax losses. So in this calculation also, the exempt person qualifying free zones are excluded. So they are not part of qualifying group, or they are not part of a qualifying, they are not part of a group for the transfer of tax losses. And also they should also have the same financial year to be used, and also they should also use the same accounting standard for the preparation of the financial statements. So that is the condition for the qualifying group, and also the condition for group for the purpose of tax losses. So here is an example is been given. So Mr. A is holding shares 80% in A company LLC, and that A company LLC is incurred a loss of 60 million in a particular year, and B company LLC is 85% owned by Mr. A and earned a profit of 75 million, and C company LLC 70% owned by Mr. A, it's earned a profit of 10 million, and D company FZD 80% owned by Mr. A, it has incurred a loss of 5 million. So which are all the companies can transfer the tax losses between the other, and what will be the impact of transfer of tax losses? We will see that. So who are all the persons which are eligible for transfer of tax losses? Here actually if you look at it, Mr. A is having shareholding of 80% in A company LLC. So A company LLC is one person, and B company LLC is also, Mr. A is having shareholding of 85%. So but in the case of C company, Mr. A is having only 70% shareholding. So C company will not be a part of a qualifying group, or will not be a part of a group for the purpose of transfer of tax losses. Also D company FZD, even though it has been 80% owned by Mr. A, but it is a qualifying free zone person, it is assumed that it is a qualifying free zone person, so it will also be not a part of a qualifying group for the purpose of relief or for the purpose of transfer of tax losses. Sorry. So let's assume that 60 million was the losses of A company LLC, and 75 million is the loss for B company LLC. So to what extent the loss can be transferred from A company to B company? In this scenario, C company will not have an impact, and D company will not have an impact, because one is having less than 75% shareholding, another one is a qualifying free zone person. So those two, C company LLC and D company FZD, can be excluded from the calculation. Only A and B will be applicable in this calculation. So 60 million losses of A company, to what extent we can absorb by B company LLC? B company is having 75 million losses. Up to 75% of the income of B company. That means there is a threshold. From the income, there is only 75% of the income can be only be offsetted or transferred from another company. So out of 75 million profit, 75%, that means 56.25 million can be offsetted from the transfer of losses. So from the 60 million loss of A company, you can transfer 56.25 million to B company, so that the B company's taxable income will be reduced to 18.75 million. And the remaining tax loss which can be carried forward by A company will be 3.75 million. So the net taxable income of B company LLC will become 18.75 by this transfer of tax losses. So that is an interesting provision, but this provision you need to see that in most of the companies the capital structure may be different. The one common person may not have 75% shareholding in all the companies. We have a very scenario that two persons having 10 companies, but these two persons is having 50-50 shareholding in all the 10 companies. But as per the corporate tax law, this cannot be considered as a qualifying group for the group. Group cannot be formed, even a transfer of losses cannot also be made, but the same, because the shareholding is not by a common person having 75% shareholding. So all these things we need to take care of while doing the planning stage. So now, in continuation to that transfer of losses, we should just discuss about the carry forward of losses also. So losses carry forward means the losses incurred in any particular year can be carried forward to the next subsequent periods of the same taxable person and offsetted against the future income of the same taxable person. So up to 75% of the taxable income in the coming years can be offsetted. Let's say that the current year the company is earned a profit of 10 million, and from that 10 million it has got a carry forward losses of around 15 million was there. 10 million, 75%, 7.5 million can be offsetted against the previous period's accumulated tax losses. It is not that full 15 million of the previous year cannot be offsetted against the current year losses. That means at least some portion, at least 25% of the taxable income in any year will be taxed. That means only up to 75% of the current year income can be offsetted against the previous year's losses. Also, the losses incurred prior to the commencement of the corporate tax will not be eligible for carry forward and offset. Also, the losses incurred prior to that person becomes taxable person is also not allowed to be offsetted against the income. And losses other than losses which has been incurred on the exempted incomes also not eligible to be carry forward. And this carry forward provision is an indefinite provision. You can carry forward these losses and can be offsetted against a future period indefinitely. And there are certain conditions for tax losses carry forward. At least 50% of the shareholders should be the same. On the time of incurring the losses and at the time of offsetting the losses, at least 50% of the shareholding should be the same shareholders. Or if there is the shareholding structure has go below 50%, one thing you need to be taken care of is that it should be ensured that the same activity is being continued by the company, or the same assets, same capital, same structures, same business is being continued by the company, then that 50% threshold will not be applicable. Otherwise, if the 50% threshold is not there, then the carry forward and offset of losses will not be, the company will be losing that provision. And it is not applicable for a listed companies which is listed in a recognized stock exchange. So going through all these provisions, what is important is that what business should do. Actually, there should be a very careful analysis of the legal structuring of the company. You should be doing a legal review, the group structuring, and also we need to see that how the group structures can impact on the tax group creation, how the qualifying group can be created, whether the transfer of losses is being available for the company or not. Also, you need to see that what are all the governance, because we all seen that from 2017 till 2013, over the last 5-6 years, the compliance ambience of the country has been completely changed. And also we should be looking about the accounting and reporting side, because that is the outcome. From there, we are going to file the corporate tax returns. There are deductible expenses are there, arm's length pricing to be determined. So the accounting and reporting should be very efficient. And also we should be educating our people, and we should be investing more on the IT infrastructure, in order to get these reports on time and make the people capable of doing that. So that is the overview of the group structures and the group provisions in UAE with respect to corporate tax law. So if there is any questions, I can answer.
The questions we can take.
Okay. Because of that shortage of time, I am just concluding. Thank you for that.
Thank you very much, Mr. Vijay.